Hello.
Okay, welcome everybody to CEPR's International Macro History Online Seminar Series. My name is Carola Frydman. I'm a professor of finance at Northwestern University. And today's paper, we lost the slide, will be presented by Sami Khawar. And the paper is entitled The Glass-Steagall Act and Bank Stock Market Speculation. And Sami is a graduate student, a graduate assistant at the University of Florida. And the paper is co-authored with Gustavo Cortes, who is an assistant professor also at the University of Florida, and Marc Weidenmier, who's a professor at Chapman University. All three co-authors are here. So that they'll be around to answer questions. So just to remind everybody of the structure of the seminar, Sami will present for about 40 minutes, and then we'll have about 15 minutes for moderated Q&A. So as you're listening to the presentation, if you have questions, drop them in the chat, and I'll be moderating the chat and asking the questions at the end of the presentation. And if you have clarification questions, also drop in your questions in the chat, but please mark them as a clarification. So use the pound key followed by clarification. So I know that there are clarification, and I can interrupt Sami with clarification questions along the way. So I think that's all by organizational details. And then Sami, why don't you get started?
Thank you so much for providing me the opportunity to present this paper. So this paper co-authored with Gustavo Cortes and Marc Weidenmier is about the Glass-Steagall Act and the consequences of commercial banks engaging in investment banking activities. So as we know, the Glass-Steagall Act is one of the most crucial pieces of banking legislation in the American history. And there are many in the favor of this act who voiced concerns about the potential conflict of interest and increased riskiness that is a result of combining commercial banking and investment banking activities. These include Nobel laureates such as Joseph Stiglitz, Bob Lucas, Paul Krugman, and also some prominent politicians and senators like Bernie Sanders, Elizabeth Warren, and John McCain. Uh, Lucas is from the Chicago School, which is not known to have a very pro regulation stance. But yet, he points out that despite the flaws of the Glass-Steagall Act, for the 66 years from 1933 till 1999, the act remained in place. There was no widespread financial panic in the United States, and this fact demands curiosity and respect. Now, on the other side, there are also many opponents of this act who often argue that the arguments provided in support of the Glass-Steagall Act lack empirical evidence. These include prominent academics like Manjupuri, Krosner, Raljan, and more recently, Charlie Calomiris. These also include policymakers and Fed chairs like Aaron Greenspan and Ben Bernanke. For example, Manjupuri points out in the 1996 paper that the securities underwritten by commercial banks, the investors were willing to pay higher prices because of the certification effect, because the combining of commercial banking and investment banking activity by the same bank increase the trust of the investors in the securities underwritten by that particular bank. At the time of the Glass-Steagall passage, there were concerns raised by the Picora Commission that there are potential conflict of interests that can arise when the same bank underwrites security issues for which it is also providing commercial banking services. However, the Picora hearings investigated Chase Securities and National City Company to be the two prominent banks that were engaging in such activities that can be labeled as conflict of interest. And Manjupuri labels them in her 1994 paper as the rogue banks. And she finds out that this troubling behavior was essentially localized by these two banks. For example, she notes that the two bank affiliates investigated systematically underwrote poor performing issues. Now, we study the less studied aspect of the Glass-Steagall Act, which is the speculation part. It is surprising that there has been no empirical study of the speculative part, whereas the act was quite explicit about curbing speculation. Uh, the heading of the act says to provide for a safer and more effective use of the assets of banks to regulate interbank control, and I quote, to prevent the undue diversion of funds into speculative operations. The act is very explicit about controlling speculative or risky activities by the commercial banks. And this is exactly the gap we address in this paper by studying the speculation part of the Glass-Steagall Act. Now, in order to study speculation of the banks, we use their perceived riskiness by the market. And the best measure to do so is to use the idiosyncratic volatility. The underlying argument is that if a particular firm, which is banks in our sample, are being perceived risky by the market because of their dealings in securities, then this should reflect as a higher idiosyncratic volatility of their stock prices. Our findings are quite striking. We do an analysis of the historical sample and of the modern period. In the historical period, we find that when the Glass-Steagall Act curbed the investment banking activities, their idiosyncratic volatility declined by 25% as compared to the median and 16% as compared to the mean. Now, strikingly, when we study the modern period using a slightly different methodology, as I will explain later, we find very similar magnitudes. In the modern period, when the Glass-Steagall was stepwise repealed, starting the late 1980s and during the 1990s, we see that the commercial banks that merged with investment banks experienced a rise of very similar magnitudes as when the act was introduced around 60 years earlier. Their idiosyncratic volatility increased by about by a quarter as compared to median and 19% as compared to the mean. And it is quite striking because the numbers, the degree of magnitude is almost the same. Of course, the sign is opposite because in the historical period, we study the introduction of the act, and in the modern period, we study the stepwise or staggered repeal of the act. Nonetheless, the degree of the magnitude of change remains almost the same, despite the fact that these two events are happening almost 60 years apart. Now, I come to the data and methodology for the historical sample. So, in order to measure the idiosyncratic risk of the banks, we use daily stock quotes from New York Times. So we use daily data to make our measures of firm level riskiness. On the day of the passage of the Glass-Steagall Act, June 16, 1933, there were 110 banks in the New York Times stock quote section. For these, we get complete balance sheet data from the Moody's Manuals 489. And as Calomiris and Vinson points out, the dominance of the New York City banks is expected. By number, more than about 60% of the banks are in the New York City, and by deposits, they are about 70%. And now as I said, we use an asset pricing approach. So we use the standard workhorse asset pricing model. We use the three-factor model to calculate the idiosyncratic volatility of a particular bank in a month. So for each month, we have the daily stock price data. We use the S&P composite factor, similarly used by Gustavo and Marc in the GFE a couple of years ago. And we use the size and value factor from Kenneth French's website. And for every bank, for every month, we run this daily stock price regression to estimate their residuals. And following Gelman and Goldstein, we make we use idiosyncratic volatility as a measure of bank risk, and here it is defined as a standard deviation of the residuals estimated from the regression above. And we also use different measures of bank riskiness, such as idiosyncratic volatility from the Kappa model instead of the three-factor model, and also a standard return volatility or standard deviation of return as an alternative measure of risk. Moving on, for the balance sheet side data, we use the Moody's manuals, which also report the securities holdings of the commercial banks. The Glass-Steagall Act allowed banks to earn up to 10% of their income from the securities. Therefore, even after the passage of the Glass-Steagall Act, banks still retained securities on their balance sheets. So these securities are reported under different names, such as other securities most commonly, also as stocks, investments, and other relevant terms. So we use these to define our OSTA measure, which is other securities over total assets. These are sizable. This variable has a mean of about 8% with a significant variation, as the standard deviation of this variable is 11% in the sample. So there's meaningful variation in the degree to which different banks were holding these risky assets on their balance sheets. So for each bank, we calculate this concentration in securities of the total assets, both before and after the Glass-Steagall Act. So for before we use the years 1929 to 1933, and for the years after we use 1934 and 1935. Now, for each bank, we define a change in the OSTM a year, which is the change in the holdings of securities by the Glass-Steagall Act, and we define a bank to be treated if that bank reduced its securities holdings as a percentage of its total assets after the passage of the Glass-Steagall Act. Our findings are robust if this fall is greater than 1%, 2%, 3%. We use a simple change, which is negative or fall greater than 0% as our baseline results. So we find total of 37 banks out of the 89 which saw this decline in their securities holdings after the passage of the Glass-Steagall Act, and we term these banks as the ones that were treated or impacted by the passage of the Glass-Steagall Act. Up next, our specification and controls are similar to Ramirez. We use a standard difference in difference model in order to study the impact of the Glass-Steagall Act on different outcomes. Here, the treated dummy is defined earlier, which shows a bank that saw a decline in its securities holdings after the passage of the Glass-Steagall Act, and post takes value 1 for the month on and after June 1933 when the Glass-Steagall Act was passed. Y is the outcome variable, and this includes different bank level outcomes. Our first analysis is on the riskiness. So we use volatility and idiosyncratic volatility measures. We show that the volatility of these banks goes down. Then we also use other measures, and we show that the act increased stability for these banks that reduced their securities holdings. Their distance to default increased. They were also able to lend more after the passage, as shown by an increase in their loan to deposits ratios. Their profitability also went up. They saw an increase in their earnings as well as their dividend yield. So now here are the first results where we regress our measures of riskiness as the dependent variable. These include the volatility, which is the standard deviation of the return, idiosyncratic volatility measured by the CAPM model and measured by the three-factor model. So the volatility of the three-factor model declines by 25% as compared to the median and 16% as compared to the mean. So these are quite economically and statistically sizable changes in the declines in the idiosyncratic volatility for these banks after the passage of the Glass-Steagall Acts, and showed how the Glass-Steagall Act was able to stabilize the banks that were required to reduce their holdings of risky assets. Up next, we also use alternative measures such as distance to default. Now, for the distance to default, we follow Bharat and Swami's naive distance to default measure, which is suited for our data limitations in the historical period. This distance to default measure is constructed from the equity ratio, the total liabilities, and the volatility of debt and equity. We also look at the lending of these banks. Ben Bernanke argued that the real effects of the Great Depression were exaggerated by the reduced aggregate demand that was caused by the lower efficiency of credit allocation post the Glass-Steagall. So the financial disruptions of the Great Depression disabled banks to allocate capital efficiently. And as a result of that, it translated to real economic effects because of the reduced aggregate demand channel. So we also looked at the impact on the lending for the banks that were impacted by the Glass-Steagall Act. What we find is that the distance to default went up by 0.7 points. This translates to about a 5 percentage point decline in their default probability. So these banks had a lower probability of default, and they actually became more stable after the passage of this act. Not only this, these banks also lended more. Their loan to deposits ratio increased by 2 percentage points as compared to the sample average of 48%. So this helps to show that the passage of the Glass-Steagall Act possibly mitigated the consequences of the Great Depression by enabling banks to extend more credit. Now, we also look at the earnings of these banks, and we find that the earnings for these banks also increased by 8% and 9% relative to mean and the median. And as these big banks became more stable, lended more, experienced high volatility, these banks were also able to pay out more dividends. We follow Daniel in the GF paper to measure the dividend yield, where it is measured by dividing the dividend paid per share in the previous year by by the price in the current month, and we find economically and statistically significant increase in the dividend, which translate to about 10% or more dividend paid by the banks that were treated by the Glass-Steagall Act. And now, finally, we also revisit how the Glass-Steagall Act impacted the rogue banks, such as the Chase and National City Company. So we examine this by separately looking at the effects on these two banks apart from the other banks in the sample. What we find is that the coefficient for these banks is negative and statistically significant across all of our specification. And this shows that the rogue banks, Chase and National City, were actually differently affected by the new regulations. These banks were engaging in particularly risky activities, and therefore, after the passage of the Glass-Steagall Act, they saw a decline in their lending, their earnings, as well as their dividends. And these changes are economically and statistically quite significant. When we include another dummy, Rogue interacted with Post, we find that the two Rogue banks actually had a 16.5% lower loan to deposit ratio as compared to the mean, about a quarter lower earnings over total assets ratio, and about a third lower dividends after the passage of the act. So these two banks that were engaging in more riskier and activities that were more prone to the conflict of interest, these banks actually had very different outcome as compared to the other banks after the passage of the Glass-Steagall Act in the 1930s. Now, these were our results about the historical sample that showed that the Glass-Steagall Act reduced the riskiness of the banks. Moreover, it decreased their stability and enabled them to lend more after in the immediate aftermath of the passage. Now, we will shift our attention to the modern period. In the modern period, the Glass-Steagall Act had a stepwise repeal. Now, we cannot use the passage of the Graham-Leach-Bliley Act in 1999 that formally partially repealed the Glass-Steagall Act, because the GLB Act of 1999 codified what was already happening in practice by that time. By that time, the Glass-Steagall Act already has had several stepwise repeal that it only put into law what was being generally done in practice. So it is because in the 1990s, commercial banks had engaged in several scope expanding mergers through their Section 20 subsidiaries. And we use these mergers to see how investors perceive the change in risk level of their banks and how these mergers change the boundary of the firm. And we use the mergers between the commercial banks and the investment banks as a staggered shock to measure the effects of the repeal of the Glass-Steagall Act. So therefore, for our modern period, we use the same time period, 1987 to 2010, as Farzad Saidi. And here we use the mergers between the commercial banks and the investment banks in a staggered diff and diff design. We get our data for the mergers from the Federal Reserve Bank of Chicago. And In this time period, there were 63 banks that had a merger with an investment bank. The graph on the right shows the first time any of these 63 banks merged with or took over an investment bank. And this graph also shows why we cannot do an event study around 1999 in the repeal of the Glass-Steagall Act by the Graham-Leach-Bliley Act, because most of the commercial banks that merged over this time period had already done so before the passage of the GLP Act. Therefore, we use a staggered diff and diff design to measure the consequences of commercial banks taking over investment banks. Now, in order to implement this staggered diff and diff design, we use the imputation estimator by Boroswak's Review of Economic Studies. So I will tell you briefly how this estimator works. In this estimator, we use the unit and time fixed effects only on the untreated observation to estimate their coefficients for the unit and time fixed effects. And after we have estimates of the unit and time fixed effects, we use the treated observations to make y hat, which is the counterfactual outcome based on the estimations on the untreated observations. And after we have y hat, which is the counterfactual outcome based on fixed effect estimation of the untreated observation, we are able to impute the treatment effect by looking at the actual outcome, by looking at the difference between the actual outcome and the counterfactual outcome. And this basically becomes the treatment effect by the Boriswak imputation estimator. And later on, when you see the treatment effect in the following tables, this would mean this difference between the actual and the counterfactual outcome as measured by the fixed effects estimations. Now,
Sammy, one
at
second.
first,
Sorry to
yes.
interrupt you. Before you
Mhm,
continue on the results, I just want to remind everyone to submit their questions on the Q&A tab at the
mhm,
bottom of your screen. This is a good time to submit questions. Sorry, keep on going.
mhm. Thank you so much. Yeah. Mhm. So now we look at the similar effects in the modern period. At first, we look at the riskiness measures as measured by volatility, Chapman, and idiosyncratic volatility. What we find is that the magnitude of these results are strikingly similar to what we saw in the historical period. The idiosyncratic volatility goes up by 24% of the median and about 19% of the mean, which is very similar to what we saw in the historical sample. Therefore, it shows that after the commercial banks merge with investment banks in the modern time period, they are perceived to be riskier by the investors. And this is reflected in their higher idiosyncratic volatility. Going forward, we also look at their distance to default measure. So their distance to default measure goes down by 0.5, which is very similar to the zero point 0.7 estimate we had in the historical period. So again, it moves with the same magnitude. This change translates to about 16% or 18% of the mean and the median. Uh, in the modern time period, we don't see any significant change in the loan to deposit ratio. However, later on, we will also explore how the nature of this lending changes. We also look at profitability, and again, the ROE, the return on equity, declines by 16% of the median and a quarter of the mean of the modern sample. So again, we find opposite results for the modern period compared to what we find in the historical period. Up next, we look at the dividend yield, and we can see that the treatment of the dividend yield declines by about a percentage point. And again, this is an economically significant result, as in the sample average, the dividend yield is 6.2% on average, and the decline of 1 percentage point is quite economically significant. Moving on, so again, we see the same story that the banks that merge, commercial banks that emerge with the investment banks at the modern time period, they see their profit volatility going up, their profitability reducing, and as a result of this, they extend less dividends to their shareholders. This is a complete reversal of the changes that we saw in the historical time periods. Moving on, we look at the nature of the lending. So we look at the real estate loans and the commercial and industrial loans. Earlier, we saw that the loan to deposits ratio didn't have a significant change. However, here we dissect separately the mortgage lending and the commercial lending. What we find is that the commercial and industrial loans do not have any significant change. However, the growth rate of the real estate loans declines by a percentage point. Here the dependent variable is the growth rate of the real estate lending and the commercial and industrial loans. Now, this decline of a full percentage point in the growth rate is economically quite significant because in the sample average, the mean average growth rate is 3.22%, and a decline of a full percentage point is about a one third of that. So again, it is an economically sizable change. Up next, we look at their trading operations and their engagement in risky activities. We look at their the holding of trading assets, their trading revenue, and their holdings of equity swaps. What we find is quite sizable increases in holdings of risky assets. Their trading assets of the commercial banks that merge with an investment bank go up by 72%. And then this is compared to an average of 1.5 billion. And the equity swap positions go up by 27%. And this is compared to a sample average of 320 million. So again, we see essentially a decline in the growth rate of their real estate lending and an increase in their holdings of trading assets and riskier assets. So this signals towards an increase in speculative activities of the commercial banks that merge with investment banks in the modern time period. Now, to conclude, we see that the Glass-Steagall Act in the historical period significantly reduced the risk profile of the commercial banks that were dealing in securities. Their idiosyncratic volatility declined by 16 to 25%. Moreover, their distance to default improved. They were able to lend more and they extended more dividends to their shareholders. We find opposite results despite the fact that in the modern time period we use a staggered definitive design instead of a definitive design in the historical period. Our results are of a very comparable magnitude and opposites in sign. And we show that after these commercial banks merge with investment banks in the modern time period, their idiosyncratic volatility and other measures of riskiness increased by almost the same magnitude by which they fell in the historical sample about 60 years ago. Their growth of mortgage lending and dividend yields decline, and these banks start holding more speculative assets, such as trading assets and equity swaps. In the historical period, we know that their holdings of risky assets declined because in the historical period, the treated banks are defined by their decline in the holdings of the risky assets. Now, in conclusion, this paper basically fills the gap around the speculative part of the Glass-Steagall Act, where we study how the perceived riskiness of banks change when these commercial banks are disallowed from or are allowed to engage in investment banking activities. And we show that the lessons from the Act remain relevant till today for policy discussion on financial stability. Thank you so much, and I look forward to your comments and discussions.
So thank you so much, Sami, for that super clear presentation. The Q&A has been very quiet, so I'm going to remind everybody, if you have any questions, submit them now. And in the absence of that, and I'll monitor as we go through, but in the absence of participants sending their questions through the Q&A, let me ask you a few questions, and maybe that inspire others to take the plunge and send their own. So let me start with almost like an empirical question. So in the historical setting, you're doing something that's a little bit unusual in the sense of defining who is treated with an ex post measure, because you're looking
Yes.
at the change in securities before and after. And that's not how we
Mm,
normally think about the differences in difference when we want to look at an exposure ex ante. And what's particularly worrisome here is that you're defining your treated firms as those that see a decline in the risky assets that therefore should have less risk, right? And then we're looking at whether that relates with risk. So
yeah.
in a way, you're
Hmm.
defining, right? Like
Yeah.
if you see a reduction in risk, shouldn't we see it, right? If
Yeah.
it's almost like you're defining your treated and controlled based on the outcome variable as or as
Hmm.
something that's very closely related. One
Yeah.
could imagine an outcome for measuring the degree of risk exposed to be related to the securities that they hold as well, and not just looking at, say,
Hmm.
idiosyncratic volatility. So
Hmm.
I'm wondering if you thought about other ways to try to create a measure of ex-ante exposure to
Yeah.
Glass-Steagall based on the actual activities of banks. That would be a cleaner way to look at this. And what I don't have a great suggestion for exactly how I would construct that, but I think that would be a much more persuasive empirical strategy to to go through this exercise, because otherwise
Hmm.
it's just really not that clean. Um,
Yeah. Thank you so much for this comment. And I agree that this is quite valid. That essentially what's happening with the change in the OSTM here is that it can become forward looking in a way because we're looking at the information that is generated after the passage of the Glass-Steagall Act. We This is something we have already thought about, and the alternative measures we are looking at will be the bond issuances or other issuances by these commercial banks when they were dealing in the security and when they were engaging in the securities business. So these are some other measures that we have thought about using, such as let's say the quality of the securities they issued before the passage of the act and look at that, or the magnitude of those issuances. It's a very valid point. The reasoning by which we followed earlier to adopt this measure was to look at the banks that were actually impacted by the Glass-Steagall Act. So the line of reasoning is that if a particular bank A as compared to bank B is impacted by the Glass-Steagall Act, that bank should reduce its securities holdings because essentially that is what the Glass-Steagall Act did. It disallowed banks from engaging in these risky activities. So
but
this has, yeah.
I'm sorry, but the impacted, sorry to interrupt, but the impacted should be the types of banks that were combining the commercial and investment bank ex ante, not the ones that
Mhm,
reduce securities, which exposed, which is
yeah.
already a metric of the risk they're taking. So I think going in that direction
Yeah, yeah.
would be
So yeah,
cleaner.
thanks. It is a very valid point. We have thought about it, and the alternative measures that we are thinking about is looking at their issuances. These are available in Moody's and also in the CFC, where we're looking at
Mhm,
the bond issuances underwritings of these commercial banks.
mhm.
And these are some alternative methods we have used to identify. Essentially, the goal at the end is to so essentially the idea of the paper is about the boundary of the firm or the boundary of the commercial bank when it crosses out of and moves into investment banking. And the idea is to see the shock that creates this change of a bank that is supposed to be dealing with in commercial banking activities moves away from investment banking activities or move towards it. And in the Glass-Steagall Act, essentially the idea was to capture these banks. So the motivation, as I said, I know your criticism is very valid, but the motivation was that if the commercial bank moves away from this investment banking activity, they should see a decline in their holdings of securities assets. But again, as you pointed out, this includes use of information that is generated ex post. And therefore, another metric to do that is to look at the banks which ex ante were engaging in the underwriting of these securities. So it can also be looked at whether or not they were engaging in securities, or also we can look at the quality or the magnitude of the security issuances of the commercial banks when they were
Mhm.
dealing in the investment banking activities. It's a very valid point, and thank you for bringing it up. Yeah.
Okay, so now we have a couple of questions. I'm gonna go to Rui
Hmm.
first, who raised his hand. So I'm gonna let him speak for himself, and then I'll go to a couple of questions from the chat.
Yeah.
Thanks, Sammy, and thanks, Carola. So my question is about exactly what you're identifying, right? So in general, the interwar is the period where everything happened in a short period of time, right? So of course, Glass-Steagall, you focus on this quasi-separation between investment and commercial banking, but there's regulation Q, there's in short succession, there's also FDIC, right? So there's a lot of things that are changing the competitive structure of the banking industry in the US in
Yeah.
the moment that, for instance, could explain how
Yeah.
a restriction, how an exogenous restriction on banking business could still result in higher lending and higher dividends, right? So if you
Yes.
use competition, right, if you compress the cost structure with regulation Q, right, that had to be good news, right?
Yeah.
And then you want to compare this with what happened with the Big Bang in the 1990s, right? So there
Hmm.
was several deregulatory moves over there.
Yeah.
So
Yes.
it's unclear exactly what you're identifying here. I don't know what would be the policy implication, right? Is this a validation of the Volcker rule,
Mhm.
or how do you want to interpret your results?
Okay, so you brought a very good point regarding the regulation queue, and also like when the Monetary Control Act was passed in the 1980 in the 1980, and then we also had subsequent deregulations in the early 1980s, and this was followed by the savings and the loan crisis. So again, the boundaries between investment banking and commercial banking have been changing. And the main underlying idea of the paper is not just two event studies of the Glass-Steagall Act and then its repeal in the modern time period. Essentially, the idea, as you said, is about commercial banking and investment banking. It is about the boundary of the commercial banks and the consequences of them engaging and not engaging in investment banking activities. So, one thing in which we can possibly address this concern is by instead of having two time windows, it can also be done in a more continuous frame in which we also have other changes that you mentioned, such as regulation Q and the other changes in the 1990s that came up. The Interstate Act can also be somehow relevant to it, because when states in a staggered fashion deregulated, how did that change the boundary of the firm and what kind of implications did it have? So instead of, you can think of the shock as a binary mode of treatment. And what you are raising, from this, I infer that it can be done in a more continuous setting. That is in which we have shocks to policy changes, regulation Q, the interstate regulations, and there was another repeal in 1987, the CBA, the competitive CBA, the Competitive Equality Banking Act of 1987, which was also defining which banks are able to or not able to designate themselves as commercial banks to be able to get benefit of deposit insurance. So these are also other examples of acts over the history that have had continuously changed the boundary of the commercial bank. And your point is quite valid that essentially, for the policy implication, this paper attempts to inform the consequences of the commercial bank and investment bank boundary being blurred or solidified, and to understand in a long time series pattern the consequences of when this boundary. What we show so far is that we see the opposite results, which is quite intuitive when this boundary was set in place in the 1930s and when it was repealed staggeredly during the 1990s. But your point of incorporating other regulations that change this boundary between commercial and investment banking, you mentioned Regulation Q, but CEPR also comes to my mind, FDICIA and the FRIA Act of 1989 and 1991 are other such regulations that were set in place after the savings and loan crisis. These also come to my mind as potential tests to see how these acts changed the boundary of the firm. So it's a quite a valid point to if your point is about expanding the shock to the boundary of the firm. So that is how I infer your point, and it's a very valid point, and this can be looked into. Yeah, thank you so much.
Yeah, my comment is really not about identification. It's about the interpretation of your results, right?
Yeah.
Because the results are counterintuitive for the historical period, right? And so I was wondering, I mean, on the one hand, you solidify the boundary between commercial and investment banking, and at the same time, you make investment banking more profitable, right?
Yeah.
Regulation Q, you also reduce the cost of, I imagine that FDIC must have reduced the average, the WACC, right, of commercial banks in the US, right? So you're acting on both sides, right? You're acting on the earnings side, and you're also acting on the cost side, right? So then I don't know what to interpret, right? But that was my point, right? So that's, and I think you got it, right? So
yeah. So for the interpretation, I mean, the abolishment of Regulation Q was around 1980, and that is not included in our study because the historical sample ends in 1935. The modern sample begins in 1987. What we show in the historical study is intuitive because we show that when the risk profile of the commercial bank goes down by them being disallowed to engage in investment banking activities, the riskiness goes down. And as Carola pointed out earlier, that this should be very straightforward because we are defining them as such. We are defining them by their decline in their securities holdings. So it should not come as a surprise that the risk profile goes down. And as discussed earlier, we will look at alternative ways to define the banks that were treated by the Glass-Steagall Act that do not incorporate any kind of information that is generated ex post. But yeah, thank you so much.
So I'll go to a somewhat related question that Pierre asked in the chat, which is that if Glass-Steagall, by separating commercial investment banking, made the commercial banks more profitable, then why didn't they do it on their own before? At least that's my interpretation of the question, right? So the question is sort of like there might be, Pierre says there might be various reasons, but have you thought about some of them? And
yeah, so one way is that this is a risky activity. And we need to look at the backdrop of what was happening at that time period. This is the time period of the Great Depression and the stock market crash. So it's a very interesting question that if them being disallowed from the investment banking activities made them more profitable, then why didn't the commercial banks just disbanded themselves from engaging in these risky assets? But it is that these assets are riskier and they're unable to see the future returns from these returns. I mean, if you look at the modern time period of the repeal of the Glass-Steagall Act, this was the run-up to the technological boom. So during this time period in the 1990s, when we are moving towards the tech bubble, essentially starting to engage in with securities and holding securities on the business holding securities on balance sheets will be quite profitable. So I think the answer lies in the backdrop of the equity returns during the time period when these banks are actually allowed or disallowed from the investment banking activities.
But then that doesn't make the interpretation, sort of the external validity of the exercise, a little bit difficult to think through. Like essentially what you're saying is a big expansion of these activities in the 1920s, where they have a lot of, they're doing a lot of underwriting business. right
Yeah.
through the expansion of the stock market, might have
Hmm.
been very profitable. You're looking at
Yeah.
a period in which they're not, and then profits are rebounding. This is why I think really thinking about the treatment and control weather
Yeah.
and the period would be helpful.
Yeah.
Let me
Hmm.
just to make sure that we get to all of the questions before we wrap up. There was a sort of big picture question in the chat,
Hmm.
which asks for your view on the relationship between your research and the contrast between the depression during the 1930s and the recession in 2008.
So by the time, as I said, the staggered repeal for most of these banks had happened by the time of the Great Recession. So most of these mergers happened during the 1990s, and which was well in advance of the Great Recession of 2008. The Great Depression, on the other hand, sits on the exact time period of when these banks were being when the Glass-Steagall Act was being set in place. So for this period, the Great Depression is more relevant to the study as it is closer to the time periods being studied. The Great Recession again is towards the very end of the time period, as we follow Farzad Swedi in identifying the sample as 1987 to 2010, which puts the Great Recession towards the end of the sample, and by which most, if not all, of the 63 commercial banks that ever merged with an investment bank during the time period had already done so.
Okay,
Mhm.
Nathan also has a question, so I'm going to go to
Yes.
him.
Mhm.
Yeah, so it's kind of a more of a policy philosophical question maybe, but again, so you understand that we understand that the Glass-Steagall Act obviously was supposed to lower the risk in the banking sector, and it was done in the 30s after the financial crisis already erupted. And so just from a policy perspective, I'm just thinking, is it, I mean, seeing what was done through COVID with the LTROs and by the ECB and everything else, don't you want to encourage in this situation some more risk taking rather than limit risk taking or after the crisis already happened? So if I'm borrowing for what the policies of the ECB and also the Fed during the COVID and so they actually went the other way in terms
Mm.
of encouraging the financial system to take more risk or to invest more, and in a time where sort of you have this collapse in demand, and so I'm just thinking about kind of
Yeah.
it's more kind of lessons. So apparently what you showed was effective, but the question is,
Hmm.
was it the right thing to do? I mean, we're still with this. They just
Yeah. It's a very good thought exercise. I mean, of course, the idea is not to go against risk taking. Risk taking can be beneficial. Farzad Saidi shows in his paper that when the Glass-Steagall Act was stepwise repealed, after these commercial banks, they were able to finance riskier firms and more productive firms. So there are benefits and upsides of allowing these commercial banks to engage in more risk because by doing so, they are able to take the risk of investing in more riskier companies. But what comes with it is the change in the composition of the lending portfolio. What we see over here is that the growth of their real estate lending declined. And what we see is that when these commercial banks, when they were allowed to take on more risk, yes, the riskier companies did get financing, which is good for economic growth. However, the growth rate of the real estate lending declined. So this actually raises concerns about the nature of how credit allocation changes when commercial banks are allowed to take on more risk. Which type of credit, which firms, which households will get more credit, and it will come at the cost of what? And also we see that as their holding of trading assets increased by sizable magnitudes, 72%, let's say, where these assets would have gone otherwise. I mean, which other households or companies would have got the financing or lending were it not the case that these funds were channeled into riskier asset holding? So these are the kind of questions, a big picture question the paper attempts to answer by looking at how, when banks are allowed to engage more risk, then how does the credit allocation changes?
Yeah, but I mean, if I
Yeah,
can
so we
add
have to
on, I
be,
mean,
yeah,
yeah, I mean, I agree with that, but these are two different environments. That I
yeah,
mean, so you're talking about the enactment of an act of this Glass-Steagall during a depression, and a reversal during a time of sort of a financial boom. The financial globalization is picking up. We had the Nasdaq, all this kind of stuff. So it's a kind of it's done in different contexts,
yeah,
and that's why I think the kind of the symmetry you're trying to draw is maybe. I mean, I would just in terms of kind of formulating it in a more nuanced way.
Yeah, yeah, that is a very point, because ideally we should have had the very same underlying macroeconomic situations, and as you just pointed out, I mean, the 1990s was a very different time period macroeconomically from the 1930s, and we need to think a little bit more about how to what these findings entail, and what this implies for the comparisons between the historical and the modern sample.
Yeah, and also the financial sector and the
Yeah.
financial options are very different.
Yes.
So
Yeah.
that makes it a little bit tricky too. We have a couple more minutes. If anyone else has a question, please feel free to submit. And I was going to point out that another difference in terms of what we can access for historical data is in the modern period, you can separate different types of loans, but in the historical period, we can't. And you interpreted the growth of the loans to deposit ratio as an expansion in credit and a positive outcome. But loans can be quite risky too. So that might be, right, if there is a risk return trade-off, there might be, I guess, like your risk measures would speak against it, but it's not so obvious that expanding on loans doesn't mean that now they're loading on risky activity on the loan on the loan side, and so in that sense, also with deposit insurance coming in, the fact that they might be able to take on more risk because now depositors are going to be less likely to fly away becomes a little bit difficult. And it's not obvious to me if you had some firms that have been they're sort of more or less trusted ex ante, right? Like there are two ways to think about the joint commercial and as you pointed out, the literature thinks about the joint commercial and investment banking activities as positive or negative, right? And one view is that now investors think they have more information, they're monitoring better, right? So they trust them more. And another view is that you actually trust them less because they're using all of that information to extract rents and load in with additional risk. So if you thought they were really not trusted that much, right? Then when depositors feel like their deposits are guaranteed, that's also gonna allow these banks to take on more risk on the lending side.
Yeah. So that can conflate the impacts of deposit insurance with the separation of investment and commercial banking. So from what you started with, looking at the changes in the credit allocation, and I said if there are riskier firms, there are also riskier households. So what can be done further is to look at the answer the question of which type of households get affected more. For example, are these minority households more that are affected by this change in credit allocation? I mean, we need to look at the cross section across mortgage market to see which kind of segments of the market are denied credit availability after these changes when these banks are allowed to take on more risk. So of course it can be done in both ways. In the early 2000s, the regulatory changes allowed banks to lend to subprime borrowers. And as a result of this, this increased riskiness in terms of lending to riskier households as opposed to lending to riskier firms. So again, what we need to see is look deeper into the nature of the households that for which the credit allocation changed, to look at how the riskiness implied by the credit extension changed because of the stepwise repeal of the Glass-Steagall Act. So again, the overall point is quite valid, that coming from the standpoint of when commercial banks engage in also investment banking, it can have a certification effect, that they have more information about the company, and also it can have this suspicion that they can actually take advantage of the weaker informational position of the investors, because the bank knows more about the company. So again, so in order to infer that which of these effects outweighs the other, ultimately it is to look at the welfare, the investor welfare metrics, such as the dividends being given out to the shareholders, and also the performance of those companies that are being extended credit to. So again, these are other areas that we can look into to further test how these concerns, to what extent they are valid or not valid when the Glass-Steagall Act was repealed. So work on this is already done by Farsad Saidi on the firm side, and I think more can be done on the household side. Yeah.
Oh, super interesting.
Yeah.
Anyone else? If not, I think we're right at the 11 a.m. mark. So before we conclude, I want to just convey a message that this is not the last seminar in the series, but there is more coming. So then next one, and maybe final, Rui, is that the final one of the season, is going to be on May 22nd, same time. And the paper will be the long-term effects of inflation and inflation expectations, and that's joint work by Fabio Bragion, Felix von Meyernick, Nick Schaub, and Michael Weber. And other than that, thank you so much. This was really a fascinating paper, and hope everyone enjoyed it.
Thanks,
thank you so much, Carola, Rui,
Thank you so
Nathan.
much.
Hope to see you.
Thank you.
Thanks, Carol. Bye.
Thank you.
Thank you.
Nice to see you all.
Bye-bye.